Hey everyone, let's be real. Saving money is a great habit. It's the first step to building wealth, but here's the catch. Stashing all your cash in a traditional savings account won't get you very far. In fact, it's like leaving money on the table, or worse, slowly watching it shrink. Think about it. When inflation is high, like it has been recently, the purchasing power of your hard-earned dollars takes a hit. What you could buy a year ago might cost you significantly more today. That's why simply saving isn't enough. You need your money to work for you, not against you. That's what we're talking about today, smart ways to put your money to work. We're diving into the world of wealth building beyond the traditional savings account. I'm going to share 4 superior assets that can help you not just preserve your wealth, but actually grow it over time. Welcome to Wealthfully Yours, the channel dedicated to helping you make smart financial decisions and achieve true financial freedom. In this video, we'll break down why cash alone won't make you wealthy and explore 4 assets that outperform traditional savings accounts by a long shot. Let's get started. When it comes to building wealth, the stock market has historically been the heavyweight champion. No other asset class has consistently delivered the same returns over the long term. I'm talking decades, not just a few years. Think about it. The S&P 500, which tracks 500 of the largest US companies, has historically returned an average of 7 to 10% annually after adjusting for inflation. Now, I know what you might be thinking. The stock market seems risky, especially for someone just starting out. And you know what? You're not wrong. Investing in individual stocks can be volatile, but there's a smarter way to tap into the market's growth potential: index funds. Index funds are like diversified baskets of stocks that track a specific market index, like the S&P 500. Investing in an index fund like VEO, VTI, or SPY is like owning a tiny piece of hundreds of companies. This diversification spreads your risk and gives you exposure to the overall growth of the market. It's a hands-off, set-it-and-forget-it approach to investing that's perfect for beginners and seasoned investors alike. Now, I know what you might be thinking. Picking individual stocks seems complicated. And you're right, it can be. That's why I love index funds. They take the guesswork out of investing. With an index fund, you're not trying to time the market or pick the next hot stock. You're simply buying into a diversified portfolio of established companies that are built to weather market ups and downs. It's like investing in the entire stock market with a single purchase. Plus, index funds are incredibly low cost. You see, actively managed funds, where a team of analysts is constantly buying and selling stocks, often come with high fees that can eat into your returns. Index funds, on the other hand, are passively managed, meaning they track a specific index which keeps fees low. This low-cost approach to investing means more of your money is working for you, compounding over time. Remember, even small differences in fees can make a huge difference in your long-term returns. That's the power of compounding. The key to success with index fund investing is to think long-term. The stock market will always have its ups and downs. That's just the nature of the beast. But over the long term, the overall trend has been upwards. Remember, when you invest in an index fund, you're investing in the future of the companies that make up that index. You're betting on their ability to innovate, grow, and generate profits over time. And historically, that's been a pretty good bet. Now, I'm not saying you should throw all your money into the stock market tomorrow. It's important to start with a solid financial foundation, which includes paying off high-interest debt and building an emergency fund. But once you have those bases covered, investing in the stock market through index funds is one of the most powerful ways to grow your wealth over time. Remember, time is your greatest asset when it comes to investing. The sooner you start, the more time your money has to compound and grow. Now, let's talk about another powerful asset class that's been a cornerstone of wealth building for generations: real estate. Real estate has this incredible ability to act as a hedge against inflation. You see, when prices rise, so do rents. And guess what? So does the value of your property. But real estate isn't just about appreciation, it's also a fantastic way to generate passive income month after month. Think about it. Every month, your tenants are essentially paying down your mortgage and putting money in your pocket. That's the beauty of rental income. And here's the kicker. With real estate, you can leverage your investment. Unlike stocks, where you typically need the full amount of cash up front, With real estate, you can use a mortgage to control a much larger asset with a relatively small down payment. This leverage can amplify your returns, but it's important to remember that it also amplifies your risk. So it's crucial to do your due diligence, research the market, and make sure you're comfortable with the level of risk involved. Let's dive a little deeper into the concept of leverage because it's one of the things that makes real estate such a powerful wealth-building tool. Imagine this. You have $50,000 to invest. With stocks, you could buy $50,000 worth of stock. But with real estate, you could use that same $50,000 as a down payment on a $250,000 property. That's leverage in action. You're controlling an asset worth 5 times your initial investment. Now let's say that property appreciates by 5%. With stocks, your $50,000 investment would grow to $52,500. Not bad, right? But with real estate, that 5% appreciation on a $250,000 property translates to a $12,500 gain. That's the power of leverage. Of course, it's important to remember that leverage works both ways. If the property value declines, your losses are also amplified. That's why it's crucial to do your homework, invest in properties that align with your financial goals, and have a solid understanding of the local real estate market. Now, you might be thinking, buying real estate seems complicated and expensive. And you know what? It can be, especially if you're just starting out. But the good news is, there are multiple ways to get started with real estate investing. You don't need to be a millionaire to become a real estate investor. You can start small with a rental property, maybe a duplex or a small multifamily unit. As your income grows, you can gradually expand your portfolio, acquiring more properties and building long-term wealth. Another option is to explore REITs, or real estate investment trusts. REITs are like mutual funds for real estate. They allow you to invest in a diversified portfolio of income-producing properties without the hassle of being a landlord. Remember, real estate investing is a marathon, not a sprint. It's about making smart, calculated decisions, being patient, and building a portfolio that aligns with your financial goals. And who knows, one day you might even be able to achieve financial freedom through real estate investing. Now, before you think I'm all about going all in on stocks and real estate, let's talk about cash. You absolutely need some liquid cash on hand. Emergencies happen, opportunities pop up, you need to be ready. Keeping a few $1,000s readily available can save you from going into debt if your car breaks down or if you have an unexpected medical bill. This is not about getting rich quick. It's about having a financial safety net. But here's the thing. Leaving all your cash in a traditional savings account is like leaving money on the table. With interest rates so low, your money is barely keeping up with inflation, let alone growing. So what's the smarter play? We're talking high-yield savings accounts and I-bonds. These are your new best friends when it comes to parking your emergency fund and short-term savings. These options offer significantly higher returns than traditional savings accounts, helping your money maintain its purchasing power. High-yield savings accounts are exactly what they sound like. They are FDIC-insured accounts, just like your regular savings account, but they pay a much higher interest rate. We're talking 4% to 5% or more, compared to the measly 0.01% you might get at a traditional bank. Think of it this way. If you have $10,000 in a high-yield savings account earning 5% interest, you'll earn $500 in interest alone in a year. That's $500 more than you'd earn with that 0.01% return from a traditional savings account. Now, I know what you're thinking. 5% isn't going to make me rich. And you're right, it won't. But that's not the point. This is about maximizing the return on your liquid cash, the money you need to access quickly. These accounts give you the liquidity you need for emergencies or short-term goals while still earning a respectable return. Plus, many of these accounts have low minimum deposit requirements, making them accessible to everyone. Next up, we have I-bonds, or Series 1 savings bonds issued by the US Treasury. These bonds are designed to protect your savings from inflation. How? Their interest rate adjusts with inflation. So when inflation goes up, so does the interest rate on your I-bond. And when inflation cools down, your I-bond still guarantees a certain rate of return. This makes them a fantastic option for preserving your purchasing power over the long term. Now, there is a catch with I-bonds. You can't touch your money for at least 12 months. If you withdraw before 5 years, you lose the last 3 months of interest. But for long-term savings goals, this isn't a deal breaker. The bottom line, I-bonds are a fantastic low-risk way to safeguard your money against inflation. They are backed by the full faith and credit of the US government, so you can sleep soundly knowing your investment is secure. We've talked about stocks, real estate, and high-yield savings, all great investments. But the absolute best investment you can make, the one with the highest potential return, is in yourself. I'm talking about your skills, your knowledge, your ability to earn. This is the ultimate asset, and it appreciates over time. The more you learn, the more you earn. It's as simple as that. Think about it. Every successful person, every entrepreneur, every high earner, they all invested in themselves. They took courses, read books, attended seminars, and learned everything they could about their craft. And that's what I want you to do. Invest in yourself like your financial future depends on it, because it does. This isn't about getting a fancy degree or spending a fortune on education. It's about constantly seeking knowledge, improving your skills, and becoming more valuable in the marketplace. So how do you invest in yourself? There are countless ways, and many of them are free or very affordable. Start by reading books. Read everything you can get your hands on about your field, about investing, about personal finance, about anything that interests you. Take online courses. Websites like Coursera, Udemy, Skillshare, and even YouTube offer incredible courses on a wide range of subjects, often for a fraction of the cost of traditional education. Attend workshops and conferences. Networking with other professionals in your field is invaluable. You'll learn new things, make connections, and potentially open doors to new opportunities. And don't underestimate the power of mentorship. Find someone you admire in your field and reach out to them. Ask for advice, pick their brain, learn from their experience. The beauty of investing in yourself is that it has a compounding effect. The more you learn, the more you earn. The more you earn, the more you can invest. And the more you invest, the more wealth you build. It's a virtuous cycle. Remember, your earning potential is directly tied to your skills and knowledge. The more valuable you become, the more you can demand in the marketplace. This translates to higher salaries, better job opportunities, and more financial freedom. So don't be afraid to invest in yourself. Take that course, attend that conference, read that book. Your future self will thank you for it. Look, we've covered a lot of ground today, from the stock market to real estate to the power of investing in yourself. And the takeaway is simple. Your money shouldn't just sit there. Money sitting still dies slowly, eaten away by inflation. But money strategically placed, that grows steadily. Don't let your hard-earned cash lose power. Put it to work. Build assets. Own your future. Whether you're just starting out or you're already on your wealth-building journey, remember, the most important step is to take action. So hit that subscribe button, smash that like button, and let's grow smarter together. See you in the next video.